What's up with this market? We tired? Have we run out of gas? What's the story?
I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower.
Fundstrat's Tom Lee joined Closing Bell host Scott Wapner to discuss the S&P's ongoing re-rating, with valuations poised to move higher and a breakout rally that could begin within days. They also covered resilient earnings, investor sentiment, market concentration. Let's hear more information.
What's up with this market? We tired? Have we run out of gas? What's the story?
I think the market's consolidating and maybe trying to get direction from what the market does, because we did gain 28% from the April lows. We got to digest that. Now we're in August, like the dog days of August, where liquidity is lower. And I think that we're still holding our breath because we're in a period where the Fed isn't going to make an interest rate decision until September. So some of the key macro is kind of on hold. So I think markets are wait and see, but I'd say that pullbacks have been shallow.
Is it fair to say there's a more sober view from investors about stocks? I mean, you've been suggesting that this is a hated V-shaped recovery, even as we continue to climb this wall of worry until most recently, where we've sort of sputtered in place.
That's right. I mean, it's definitely the most hated. I can attest to it from our conversations with clients. We can see it measured in surveys like AAII, where there's stubborn bearishness net still. And then we did the rounds, Fundstrat did the rounds with a lot of our institutional clients the last 2 weeks. And I think folks are very cautious, which is actually good for stocks. They're cautious because, of course, markets have moved and our clients tend to be valuation sensitive. But I think adding to their frustration is that during that April downturn, many were selling their best names because they were trying to get defensive, and then they haven't fully reloaded yet. So I think that's why there's still room for stocks to go up.
So your clients are valuation sensitive, which makes me almost want to laugh, because is anybody valuation sensitive to what's been going on in the market? We're historically well above the averages on the prices that you're willing to pay for stocks.
Yes. I mean, what we usually tell our clients, but really at the core, any fundamental investor is going to use valuation as really one of their anchors, is that the stock market had 6 stress tests in the last 5 years, from COVID to the bullwhip supply chain, to the fastest inflation cycle in history, to the fastest Fed hikes in history, then to the Trump tariffs, and then, of course, U.S. bombing nuclear facilities of Iran. Those are things that could cause catastrophes for earnings, but instead the S&P earnings have actually grown. So I think we're in the process of re-rating the S&P. So I actually think multiples are continue drifting higher.
Okay, so let's talk about other so-called knocks on the market. Valuation, obviously, one of them. They say there's too much speculation. You look at some of these stocks, meme stocks, low-quality stocks, cult stocks, and other things that have gone up. With these stocks? What's happening with some of this fervor that feels like it's in the market?
Well, I think the dearth of IPOs over the last 5 or 6 years has shrunk the number of stocks in the U.S. stock market. There's not even 5,000 listed stocks anymore.
Yeah, I'd give you 50 examples of other things that have just gone absolutely parabolic.
Yeah. Well, I think like a Circle is a good example of scarcity, because that was the best IPO really in 5 or 6 years. But it's a blue chip company. They are the biggest compliant issuer of stablecoins in the U.S. and it's growing prodigiously. So in a way, it makes sense that it went from, a $20 IPO to $200 today, because it's scarce. It's just as scarce as a Palantir, but with a different market size. And I think that these quality names like a Figma represents that same scarcity, because we actually have a shrinking number of stocks out there. There's a lot more privately held companies, but the public market's small. And then if you think about it, there's every year dividends are paid on the S&P. That's sitting on the sidelines. There's $7 trillion of cash on the sidelines. People make income and they're saving 10%. If they don't buy stocks and they haven't been able to buy homes, this cash is piling up, and that's why it probably goes into the stock market.
Okay, so the knock of valuation, the knock speculation. What about the knock of concentration? NVIDIA has the biggest weight in the S&P 500 of any individual stock since 1981, since data was being collected. The largest 10% of U.S. stocks now account for 76% of total U.S. market cap. That's the highest concentration in history. The top 10 names in the S&P account for 40% of the index. Does that give you any pause?
I think when people cite these numbers, and I've also heard Max Myers say that like 2 stocks are bigger than like Tokyo's entire stock market.
Max is going to love the shout out, by the way.
Yeah.
Anyway, please go ahead.
That we have to think about the earnings contribution. NVIDIA is producing incremental earnings at an incremental margin that tells you it's an incredibly scarce company. They're not making enough chips, and they are the center of the AI revolution. So I'm not surprised it's the biggest stock. I think from an earnings growth contribution, it's so big that those previous measurements aren't accurate.
Okay. Last one. The consumer, not as great as everybody says. Brian Moynihan, Bank of America, comes on the network this week, has great things to say. I always say, don't listen to what people say they're going to do, listen to what they actually do. And what they're doing is still spending money. Hugh Johnson, Disney, says, I know there's a lot of concern about the consumer. Well, we don't see it. Our consumer's doing very well. Under Armour, Crocs, Ralph Lauren, Pinterest, restaurant brands, Sweet Green, Wendy's, Chipotle, Jack in the Box, Yum Brands. I could go on and on even further than that, which might tell a little bit of a different story. So how do I square that?
Well, I think there's consumer preferences could be shifting. Because you remember, post-COVID, there was this boom in eating out and dining experiences. And we shouldn't say that that's a permanent change, and that's why you're seeing some of these. I don't think consumers are over-levered. To me, that's the sign of a peak in consumers because they can't amplify their spending. That's what the banks are going to tell you. And if you look at the Fed's debt service ratio, we're still below COVID levels. So
people keep saying delinquencies are going up, consumers stretched.
I think that, of course, at any moment there is, but really in aggregate, you can't get a levered consumer until you have a housing boom. So consumers might be on short-term credit, some of these being stressed, but that's very different than us actually peaking really from long-term credit borrowing in a binge.
So that's why you say we're going to hit 6,600 by year end on the S&P, or it's almost 64 now. That's not like a tremendous move from here.
Yeah, I mean, I think our year-end target is probably low because I think we could do 6,600 this month. I think this is the month.
This month?
Yeah, I think we're going to have a breakaway move in the S&P this month.
Even in what is a historically, not the best seasonal period for stocks, we know. August is usually like a nothing burger, and then September is usually a reversal.
That's
negative.
Right. I think that's everyone's playbook, that August should be weak and September down. But precisely for that reason, with the economy being stronger than people realize, Bitcoin made a breakaway move on July 9th. It has led the S&P for the last 5 years by almost 1 month. So I think a breakaway upside move in the S&P is coming.
All right.
Yeah.